Hey, welcome to the podcast, everybody. Thank you for joining me. It is a Monday. Hope you had a great weekend. And the stock market continues to just, well, the phrase they use on Wall Street is consolidate. Basically just means move sideways. It after the big run it's had since really mid-November, just moving sideways now. And there's a lot of people that were looking for maybe a major pullback, and we haven't had one yet. Obviously, getting a pullback to this uptrend line would be an easier entry and then blast off. That would be an ideal thing to do. But I think the bottom line is what you have to be looking at right now is with the spending cut talks, the debt ceiling, all those things starting to heat up, and we knew they would, and they're going to heat up even more as we get closer to February and March and so forth. The market could get a little jumpy. And as of right now, the volatility is, of course, very, very low. We talked about that in prior podcasts, how either it's setting up to be you buy volatility and things are going to get very, very shaky and you should be selling the market right now, or perhaps we're in a new low volatility time frame like we were in 2004, 2005, 2006. It's too early to tell yet, but we do know volatility is still very, very low. And so given that, right now the stock market is just simply moving sideways, and it's bullish. It's bullish because a lot of money came into the market last week. We saw, going back to last year, we saw about $146 billion pulled out of equity mutual funds. And that, I think, started to come out pretty heavily. Obviously, people were worried about the election. They were worried about the fiscal cliff. And so a lot of people just simply checked out of the market and said, I'm going to get out because I don't want to get burnt like 2007 and 2008. And, of course, anytime you do things, all the way, either you're all in or you're all out or you make these dramatic decisions, generally they're wrong. And a lot of people that got out completely are now scrambling to get back in. In fact, we saw a record, really a $8.9 billion of money flowed back into stock mutual funds last week. And that was the highest, I think, since 2007. Now, the caveat to that is you're saying, wait, 2007, wasn't that, what happened in 2000? Oh, yeah, the peak. The stock market peaked in 2007. So the last time we saw this type of money flowing into stock mutual funds was at the absolute peak of the stock market before it was just about to tank. So, take some of these numbers with a grain of salt, both for good and bad. But the bottom line is we did see money flow into stock mutual funds. I think it's not a huge positive or a huge negative. I think it's a lot of money that was simply coming out in the last few months of the year is now coming back in, getting put back into position where it was after people saw that, yes, the world didn't end, the Mayans weren't correct, all those things. So now that money's coming back in. So we had the huge move after the fiscal cliff settlement, we'll call it, negotiations, whatever that was. We saw that big move up here, and then we've just been moving sideways ever since. Now, we did break above last week, and so a lot of people thought we were off to the races. We could have what I always like to call kind of a fake-out breakout, where you bust above here, and then you come back into here, and everybody says, oh, no, I read this completely wrong, only to get whipsawed once again, and it's off to the races. So, these lines aren't exactly precise. We know we're up near this high, but I think the longer we spend up here without giving a lot of it back, the stock market will react favorably, and up we will go. We are seeing, really some of the highlights lately have been transports, which have been continue to move up, and you see they kind of broke out of this long trend, sideways pattern here. They broke up. They've been very, very strong. A lot of people believe that's because the economy is getting better, whatever the reason, but it's riding this up and was up another 0.5% today. Of course, financials have been very, very strong. Actually bounced back quite a bit today as well, only down 0.25%, even though they were down maybe almost 1% earlier in the day, but they've been very strong. I remain long financials. And also, things like small caps. They didn't make a new high today for the first time in a while, and they were up at a new high. So you have things like that. You have semiconductors, doing very well. So you have a lot of the technology, a lot of the financials. You have small and mid caps. You have transports. Everything that you would want to see going up is going up. But What do you do right now? Do you run and chase this? No, you don't, because in the short term, we did get overbought, not necessarily as extreme as we did back in September during that time frame, but we are seeing some things that are telling us pause a little bit. At least you might get a little bit better entry. But if you're somebody that's way, way underinvested, meaning you have a bunch of cash and you don't know what to do with it, and you think, oh, I'll buy it when it gets a lot cheaper, you may be waiting. So you might want to average in for those dollars, but you're going to have to determine what you want to do for 2013. This is the time to look into and come up with your game plan. I've spent the last 3 months or so really revamping the overall portfolio, not necessarily making wholesale changes, but really compartmentalizing various strategies and saying, look, I have this piece of the portfolio and it's designed to do this. Whether that's a trade, whether that's an investment, whether that's some type of all-weather thing that you're buying, whether it's something you're buying for income, you have to go through your portfolio from this 30,000-foot view and really identify what you're trying to do and what you're trying to accomplish. And again, if you're somebody that wants to trade your whole portfolio, fine, identify it and do that. If you're somebody that says, no, I understand some of these gyrations, but I'm more of a long-term investor, then okay, pick your battle and find where you're going to invest and just come up with a game plan. But I really think this is a time that you should be doing that right now, because you need to understand that the markets are going to, obviously the volatility may pick up at some point, and you need to be prepared for that in advance, not in the middle of it saying, now what should I do? You should prepare for that right now. So I really think this is the time to look at your overall portfolio, not necessarily just your trading piece but look at the overall picture and decide what you're going to do this year. Now, obviously, we don't know how this year is going to turn out, so we can't say, oh, I'm going to do this and just stick with it the rest of the time. But your strategies, those can be identified now. How much of it do you want for trading? How much of it do you want generating high amounts of income? How much of it do you want for investing? And I think once you identify that, then you'll be able to sleep at night knowing where you want to live in this investment world. Because I think a lot of people don't know that. A lot of people believe they're long-term investors. They hear guys on the radio, perhaps, talking about that you just throw your money in mutual funds and you leave it and you make good money. And there's years like last year that works, and there's years like 2008 where it may change your life because you lose 40% because some Yahoo on the radio says buy and hold, it averages 12% a year for your whole life, and that's not true. Go look at the numbers. What happens is there's good years and there's bad years. The problem is a lot of you can't afford the really, really bad years because a 30-40% decline will literally change your life. So you have to decide what you want to do. But if you're somebody that thinks you want to be a long-term investor and then all of a sudden things get volatile and you want to change your tune at that point, you can't do that. You have to go into it right now and realize things aren't as great as you think and things aren't as bad as you think. The Perma Bears last year, got very frustrated because they sat out and they didn't make any money last year. The Perma Bulls had a good year last year, but then again, if something like an '08 comes, or even a summer of 2011, remember it wasn't that long ago. If we go back to the summer of 2011, remember this? This was the last time they talked about the debt and we got the downgrade and everything. You remember we had I'll zoom in a little bit, but we had 400-point days in a row, I believe it was. I think that was correct, right in here. And we fell very sharply. I think this was a 22% decline in literally a matter of, 10 trading days? And it was a very tough summer. So for those people who were buying and holding during that time, they lost a lot of sleep at night. For those that did a lot of trading, they perhaps made a lot of money or at least avoided a lot of pain. And again, if 2012 was a time where perhaps you could have had too much trading. So each year is different, and we know that. And we don't know what 2013 will look like. I can tell you that based on previous post-election years, which we're in now, we're in a post-election year, the stock market tends to have a pretty good January and February, tends to have a spring sell-off, and then a rally after that. But it may be different. The reason I point it out is because the presidential election year, which was 2012, the market did exactly what it historically has done for those years, which is very odd. Because every time I see those types of seasonality things, The one time you go to invest based on that is when you get burned. But it's worth noting. And so this year, we could see the market have a pretty good January, February. Then obviously, as the debt talks accelerate and they start fighting and the stock market starts to go down and we run the risk of another downgrade. So that could be coming. We don't know what the rest of this year will look like. But we do know that we can develop a plan right now and determine, okay, what are our expectations? Is this going to be a year where the stock market makes 30%? Do we expect the stock market to lose 30%? I think most people, when you look around, expect this to be a ho-hum year for the stock market. You're going to get some dividends. You're going to get some appreciation. You're going to have a little bit of volatility. But with earnings not being able to grow as fast as maybe they did coming out of the recession in '08, and with the economy growing at 2% maybe, it's going to be very tough for the stock market to have a gangbuster year. But I think it could have a very good year, and I don't still see any signs that this thing is rolling over, turning into a bear market. I think we could be set up for a little correction right now, but right now it's a buy the dip. With that said, we're not in a raging bull market like we were at the beginning of '09 or like we were in the 1990s. We're in a secular bear market, meaning sideways, and we're in a cyclical bull market. If we take a look at the stock market going back here, this is a sideways secular bear market, or sideways market at the very best, right? That's what this is. Up, down, up, down, up. No meaningful appreciation. So what do you do during that time? You trade, you get income, but you certainly don't spread the money out into a bunch of mutual funds and just let them ride, because you'll get this type of return. Now, the logical step for this market would be this, and a lot of people are expecting that. You know, we went up, we went down, we went up, we went down, we went up, and of course we should go down right now. Well, maybe not. Maybe we go up a little further. We don't know. The bottom line is that in general, this pattern is still existing. This is still the period we're in until proven otherwise. So we have to prepare for that. But when we zoom in a little bit, the cyclical bull market, and I'll change this. This is quarterly. I'm going to change this to monthly. And we'll go back to 2009. And you can see that this cyclical bull market that we've been in, and I say cyclical, is getting tighter, but again, it's still intact. Okay, it's intact. Yes, it's very long in the tooth. If you start it from this period here, very long in the tooth. Typical bull market would have lasted somewhere around here. This is your typical bull market length. And so everything that we're going on right now, meaning these few months, are on borrowed time. But that doesn't mean it has to end right now. So what we have to do is we have to look what things were present back in '07 here that led us to believe that we were going to enter a bear market. And many of you have been listening to the podcast for the last several years. And you remember back then there was plenty of warning signs, not necessarily to tell us the magnitude of this drop. Nobody saw that coming. But that a bear market was coming, or a very tough market. And those warning signs are not present today. And that's huge. That's very big, because then it frees you up to come up with a different game plan. And as we move along in the next few months, obviously we will look for some of those signs. But in the meantime, what I'm looking to do is allocate my capital the best way possible. Because we're not in a raging bull market, I have to have a portion that's in income. I have to have a portion I use for trading. I have to have a portion that I want some good deals on some really good quality companies. I look for undervalued corporate bonds. Bonds are a horrible word right now, right? How can you possibly be buying bonds right now? Because I'm finding awesome deals. That's how I can buy them. I don't worry about the treasury rates right now. These rates, while they may be ticking up this year, I'm buying bonds that are 5 years or less, undervalued companies. So I don't worry about the interest rate. I worry about the quality of the company. But you see, these are all pieces of the puzzle. These are all pieces of the overall portfolio. And I think it's extremely important you understand how to manage your portfolio, not just managing individual positions or individual funds or anything like that. You have to manage the whole portfolio. You own security A, because security C is in there, or security B is in there, or security D is in there. They work well together. But I can tell you this right now, there's not a whole bunch to do, and I would say be a little patient right now. If you're somebody that's got a reasonable amount invested, you've been enjoying some of the gains in the recent weeks, don't buy right here. Don't overbuy. I would basically be averaging it if you're not already in, or waiting for a little pullback. But we're not seeing the real intense sell-off that you would have expected after the big move, and that's bullish in and of itself. Obviously, a lot of these moving averages, like the 20-day moving averages turning up, and you see the 50 turning up, and the 100s turning up, and the 200 maybe turning up as well. Those are all bullish things that I'm pointing out that everybody tends to look at. So it's kind of a self-fulfilling prophecy. But overall right now, there's not a whole bunch to do. So because of that, the podcast is going to be a little shorter than normal. So there you go. Thank you all for joining me. Appreciate it. Don't forget to check us out on Twitter, eggerscapital.com, Facebook, Google+, and, of course, carleggers.com as well. Thanks for joining me. Appreciate it.